Okay, third area, dot-com bubble. We think more has yet to happen on this. I'm going to go through the reasons why. Once upon a time, if you were around, many of us were, back in the late 90s, the story was, hey, go and live on the beach, man. You can have $1 million business and run it from a bar in Barbados. That's what the internet is. And that's kind of what a lot of people still think it can be. Is being online easy money? Well, certainly the startup costs are very small, and the stories about riches easily coming to millions of people and being able to trade, and you've probably seen all the schemes that you can join up to and how much money you can make and the fancy cars that you'll get as a result of it and all the rest of it is all around the place. And that leads to legions of new entrants taking a punt, right? Which means the price competition is fierce because you've got a whole bunch of people turning up and having a go and not understanding the true pricing and cost implications of being online, because there are a whole load of costs that you don't know about unless you do your research. And these businesses start trading and they may seem profitable, but then all of a sudden they get a problem. They get somebody default, they get some fraud take place online, for example. They get somebody default, they get a non-payer, and the problem is they've been making so little margin that order just knocks them out. They fail to plan to make sustainable profits. Logistics costs. People don't get the fact that in actual fact the smaller the item becomes, the bigger the proportion of price that's all about postage. It becomes less attractive to buy small stuff online than big. And when it comes to the likes of supermarkets, it's bloody expensive. Because I picked it all went into the lorry, it came to the store, we took it all out, we put it on the shelves, we got an order, we picked it all back up, we put it on another van and took it to the customer. Yeah? A whole load of incremental cost gets put in, which unfortunately these guys have to do because all the others do. So there are very few successful pure plays, and those that are actually pushing up their margins. And I'm sure you've all seen the likes of eBuyer, who used to trade as being very low cost, and are now lifting their margins and their costs. And even Scan, who are positioning themselves more as a specialist supplier and are pricing more accordingly. Yeah? Oh yeah, really? Let's have a look at what this points out. What this pans out at. This is Office of National Statistics data from the latest I can find it, 2010. If you're online, how much are you selling? Now it includes pure plays and it includes bricks and mortar, right? But it's broken down by the standard classifications of micro, small, medium and large, and the standard well-known sizes of businesses that go with them. Average value of sales on the internet. Anyone like to guess, on average, how much is a large business in the UK making online? Hundreds of millions, tens of millions, a few million?
5 million.
Pardon?
5 million.
5 million, okay. What about a micro business? On average, how much a micro business is making online? No idea, okay. Pardon?
50k.
50k? 50k, okay. Let's take a look at the numbers. Well, of course they're making lots. They're big. And of course they're not making much. They're small. Hang on, it's not actually that simple. These guys are brands. They are known in the marketplace. Yeah? They can attract business relatively easily. Who the hell are you? Now I may know you if you're local, and that's another indicator of what I'll be talking about later. But do I know you if I'm in London and you're in Elgin? Or even if I'm in London and you're in Twickenham? Yeah? Or if I'm in Leeds and you're in Holmfirth, or the other way round. But the really important part, because you might say, well, £1,000, actually, yeah, I'd rather have that. You have to ask yourself, is it worth the effort? Because on average, if you look at that from the point of view of what proportion of turnover it rakes out to be, is it actually worth the effort? 0.6 of turnover on average. 0.6 of turnover on average. It's tiny, isn't it? Now you still might say, well, you know, I'm quite happy, I'll give it a go. And if that's the case, fine. But just be wary of what the returns are going to be. And remember that old adage, be on a beach man, $1 million business, Bahamas, no problem. Some people did it. Yeah? Amazon, eBay, PayPal, those people. Yeah? Those are the people that did that. I'm afraid it's probably not going to be us. Okay. Yeah, talking about Amazon. Jeff Bezos, that's the man who set up Amazon. And this is what's interesting. Amazon was set up in 1995, $10.5 billion worth of capital invested by 2012. Quite a lot of money. IPO'd in 97. Currently runs at a price equity ratio of 400. That means, boy, do people expect this to pay dividends in the future. This is a stock well worth buying. Yeah? This is, if ever the internet dream existed, this is it. Because it's been around ever since it started, and it's still around, and it's still growing. Jeff Bezos owns a lot of stock. $29.7 billion is his net worth. Not bad. Not bad. Now, no dividends since 1997. Yet everybody's waiting for it. Quarterly results July of this year. Hey, we grew 23%. That's not bad going, it has to be said. Even this, you know, that long into being in business. We're $19.3 billion, and we made a loss. And we made a loss. If I point in the right direction. Since '97, cumulative sales of $315 billion and a cumulative profit for the same period of just 2. That is a 0.6% profit margin. Even Walmart makes more money than Amazon. And Amazon is supposed to be in the place where all the money is. Things are just not what we are told they are. Yep, the big guys find it tough. And could it be that the market is starting to get shaky? Amazon's share price dropped 17% since the beginning of this year. Are the chickens starting to come home to roost? 400 times price to equity ratio is a lot of expectation to have frustrated for a 19th year. So the market strategy, what everyone thought was going on with Amazon was, well, yeah, we'll invest, we'll buy the market share, and then when we've got the balance, we'll turn it around and we'll put the prices up. Well, why hasn't it yet happened? How long are you going to run sucking money out of the system? Right. I spoke about advertising earlier. Advertising spend. Excuse me, advertising spend. The internet is funded by advertising. Apart from investors, what makes the world go round? Advertising spend. Yeah? Because the old adage is advertising is about eyeballs. And on the internet, you can set up a business that's seen by billions of eyeballs every day. And the rise of spend on the internet has been relentless. And it has been largely at the expense of newspapers and magazines. There's been a complete shift, and that's why a lot of local press has been going out of business. That's why newspapers like the Times and possibly I think the Guardian, anyway, certainly the Times, have started subscription-only services. Yeah? They're starting to have to monetize because they can't pay through advertising anymore. Yet, something's going wrong. Endless rises and investments in advertising that are failing to deliver growth. It can't continue. And the other issue around all this is, of course, advertisers work in a particular way. But traditional advertising, the stuff that gets written on paper, yeah, washes whiter than white, you know the stuff. People don't trust that. This is from new research from Lancaster University, done in 2010. 95% of people don't trust advertising. You would never say your product's crap, would you? Of course not. You're always going to say it's good.
Unless you're Mr. Ratner.
Unless you're Mr. Ratner. Yeah, indeed. And look what happened to him. And look what happened to his business. 8% of companies trust what companies say about themselves. You can't be trusted. None of us can be trusted. We wouldn't say it was bad. 58% of people, the balance, it's getting close, but the balance say companies are only interested in selling products and services to me, not necessarily the right products and services. Yeah? You are out to sell because you are in business. Yeah, you are. The issue is how you go about doing it. Only 17% believe companies will take what they say seriously. Not a particularly brilliant picture. So, is advertising actually killing the golden goose? Because what have we seen more and more of in recent years? Interruptions, pop-ups, trailers at the beginning of YouTube videos. Stuff you want to get at that's free to access, you have to go through a bloody advert to get to. I've signed up to subscriptions for business services, for business information blogs. Part of the sign up is enter the name, you enter a code. Part of that code was I had to watch a 10-second advert to get the code displayed. That is the worst example I've ever seen, but somebody did it. It just shows there's a problem. There's a real problem going on. Because this is the issue. The internet gives you enormous choice. Yeah? Okay, you may not be able to buy from the world, practically speaking, but you can certainly buy from an awful lot of suppliers. Why should I bother to buy from you when you bombard me with ceaseless bloody banner ads and pop-ups when I can go to this other website that doesn't? In other words, the advertising is not working in the favour. It is not attracting the eyeballs. It is driving them away. Where the eyeballs are, and nobody has yet mastered this, and I will not claim to be an expert in this whatsoever, is this whole rise of social endorsement. Yeah? People saying that things are good. The issue is what are Facebook, what are YouTube, already mentioned, Twitter have started doing it now. They're using old school marketing techniques to monetize their platforms. I'm going to introduce you to a guy called Yaron Lanier.
The advent of better and better information tools is having a contracting effect, where more and more of the economy is being made efficient in this way that concentrates the wealth of those who make it efficient. I mean, just think about the day that all those cabbies out there lose their job because their cars are driving themselves. What are they going to do? I don't think they'll be happy. But whoever does that will become very, very rich. So whoever owns the top server in a big efficiency making exercise becomes very, very rich. So there's this huge concentration even as the overall economy is shrunk as a result. I'm going to use a different company as an example, an old, less fashionable one, which is Walmart. So Walmart was one of the pioneers of using computer networks to make the world efficient, for consumers anyway. Walmart in the 80s and 90s started to develop its own version of digital networking, especially in the 90s, to precisely calibrate who to buy from at the best price, where to ship it exactly when, and how to ship it, and how to stock it at which store when. I mean, this whole incredible system. And as a result of that, it was able to look to offer lower prices to its customers. And everybody said, yay, lower prices. But the thing is, it became so big so fast, which is what happens when you do digital networking, that it kind of took over the world and changed its own environment to make the whole environment of retailing consumer goods and creating them more efficient in a certain way that impoverished its own customer base. So all of a sudden, its very own customers have fewer job prospects. All of a sudden, its customer base gets poorer. And now it's kind of dug itself into this rut where Walmart is no longer as exciting a retailer as it was, because what's it going to do? And it's trying to sort of climb up scale, but it can't, because its customer base can't support it. So to me, Facebook is essentially Walmart for new generation. What Facebook is saying, free services, free social networking, free, and everybody say, yay, it's free. But then the problem with that is that the job prospects for the vast majority of people are actually gradually decreasing as less and less stuff is monetized. So what you want to do to have an information-based economy and preserve capitalism is to monetize more and more of the world instead of less and less of the world, because you want the market to be growing instead of shrinking. But the problem with the Facebook approach is it's monetizing less and less, because it's saying, no, all this is free. Your reward for participating is reputation, karma, connections, and all those things are very real, but they're not monetized. They're not securable. You can't get a house mortgage based on your Facebook reputation.
Yeah, and you can't. Yeah? Some interesting things that Yaron says there. He's an interesting character, obviously. He works at Stanford University, I think, and he's employed by Microsoft to do sort of thinking into the future and all of that good stuff. There's some key points that he brings out there around how the internet at scale, which is what the game is about, the internet at scale is actually impoverishing the very people that are buying products from it. You can, what's it all about? It's all about productivity enhancement. It's all about productivity improvement. Less jobs and lower grade jobs. Yeah, that's the big picture, and it's really quite frightening. So, here's an individual that you might claim or feel that is possibly morally bankrupt. Is the internet similar? That's Lance Armstrong. Well, those with the biggest servers win. That's fair enough. Capitalism is capitalism. It's always been about competition. And wealth will be concentrated into the few, but it's going to be concentrated like it has never been able to be concentrated before. Yeah? But relentless falling prices, this never-ending, this never-ceasing pressure on productivity and cost has only two outcomes. You can only keep moving your manufacturing around the world to lower cost domains until the lowest cost domain is no longer lowest cost. Everything starts to rise, yeah? But it will lead to increased unemployment. It will lead to impoverished consumers. So we believe, this is a bit of a longer scale, but there's a crisis coming, and you're starting to see the evidence of it. Inequalities will ultimately drive public opinion, and that will be the driver for governments. That will be the driver for governments. And what will follow will be stuff around tax. Yeah? People have started to get peeved about Amazon and Google and some of the other global players who have been playing the rules for ages, the likes of Starbucks. I worked on a job many, many years ago relocating Pepsi into Switzerland, saving them 55 million a year from European operations. So people have been playing the tax game for ages. It's just in a world that is developing a sense of its own sort of consciousness and morality like ours is, that is becoming less and less acceptable. And once those taxes come in place, that 0.6% profit margin that Amazon was once making will evaporate, because there's just not enough money there. And the ultimate thing is, the internet could actually go backwards. Yeah? There could be a reverse going on. And what we've seen as the rise of what the internet does is not what it ultimately becomes. This is just some extra stuff. UK leads the call for an end to this internet tax era, the loopholes that exist. Some of the facts and figures, Google paid just short of £1 million on £239 million worth of turnover. Amazon made 3.3 billion sales in the UK in 2011 but paid no corporation tax. Starbucks, okay, it's bricks and mortar, they're not online, but it's the principle we're talking about here. Yeah, paid just £8.6 million of tax in 14 years of UK trading. People are no longer prepared to take this, and it is growing. It is growing. There was the Main Street Fairness Act in the United States, which is all about interstate taxation, which has been pushed to one side at the moment, but it was raised and will likely come back. We've got stuff going on within Europe. The UK is lobbying the OECD. Changes afoot. So a summary of where we are. Yeah. Is growth materialising? No, it's not. It's nowhere near what people said it would be. It's completely asymmetrical. Everyone made these gross assumptions about how it would work and where it would come from, and it has not panned out like that. But more importantly, those growth rates are actually crashing. And they're crashing because what's convertible has been converted. It's over. Yeah? We've seen that even the big guys find it incredibly tough. The internet's good at anything, it's about selling at scale. Amazon can't make money. We can't make enough, can't make decent money, can't make money reliably. Certainly not enough to pay dividends for people that were really wanting them. And all this social stuff that's going on. Inequalities driving public opinion, a growing mood of tax avoidance, an intolerance to tax avoidance. And how will we tackle this? So, we think the chickens are coming home to roost. We don't know when, but they're coming. The realities confound the predictions. Yeah? The stories you're getting told are not the real truth. They are summation of all those data, all those figures that I said earlier are actually just representations of things like channel displacement. Investment will never be recouped. Huge vested interests are at play. We all look at the internet loads, don't we? The advertisers are all over it. It is in their interest to keep telling everyone that the internet is the place to be, because that will keep you spending more and more money on internet advertising. And we've seen the growth of that line, but it's failing to deliver. And there are some moral issues that are becoming more and more confronted as the internet destroys jobs, continues to avoid taxes, and all of that stuff. The correction is inevitable. There is another bubble coming. And we would say that the internet is broken. What you see now is not what's going to be around possibly even in a few years' time. It may take longer, but there are some things about this medium that are fundamentally flawed and cannot persist. Data and information for this this talk was from two major sources. There was stuff we dug out ourselves from the ONS. If you are interested in finding out more, you can go online and download this paper by Mark Thiel, the head of research at CBRE Consulting. It is an absolute gem of a paper. It's written from the point of view of retail premises, but in order to explain what's going on retail premises, it talks an awful lot about many of the things that I covered today. Well worth looking for, downloading. 8 pages worth of absolute gold.